Okay, I want you to picture the scene. It's Monday morning. You're holding your coffee. You open up your trading app or, just catch the headlines on your phone. And you see a number that just doesn't make any sense. You see gold. The asset your grandfather told you was the only safe thing in the world. They put it under the mattress insurance policy. And it is absolutely hemorrhaging value.
It wasn't just a bad day. I mean, it was a historic bloodbath. I've been watching these markets for a long, long time. And safe havens they aren't supposed to evaporate like that.
Right. I had to refresh my screen. We are talking about gold hitting an all-time record high, flirting with $5,600 an ounce. I think it was 5,995 specifically.
Yeah, it was right up there.
And then in the blink of an eye, crashing below 4,800, that is nearly an $800 drop. A massive amount of global wealth just deleted from existence.
In days. And honestly, as shocking as gold was, that wasn't even the headline for me. The real jaw-dropper was silver.
Oh, the silver crash was nasty.
Nasty is an understatement. Silver plunged 26% in a single trading session.
26%.
I mean, if the S&P 500 dropped 26% in a day, society would basically shut down. For a major global commodity to do that, that's a systemic collapse. It's the steepest drop on record.
So naturally, the question everyone is asking is, why? Why is the boring, stable metal market suddenly acting like a meme stock on Reddit? Is the sky falling? Or is something else going on here?
That is the billion-dollar question, isn't it? And when you dig into the reports we have today from the U.S. Treasury, from the Shanghai Gold Exchange, testimony from the Senate, turns out this isn't just about supply and demand.
It's bigger.
It's way bigger. It's a story about a speculative meltdown, a coordinated regulatory crackdown, and maybe even a shadow war over the future of money itself, involving China and digital currency.
That's quite the list. So our mission today is to unpack all of that. We need to understand what triggered this, who got hurt, and why the U.S. government thinks this might be a dry run for a new financial world order.
Let's dive in.
So let's start with the official explanation. The phrase of the week seems to be speculative meltdown. And this comes straight from the top, right?
It does. U.S. Treasury Secretary Scott Bessent, he went on Fox News Sunday Morning Futures to explain the chaos. And usually when you see a Treasury Secretary during a crash, they try to be calming.
Right. They use vague words, market headwinds, or correction.
Exactly. Bessent didn't do that.
No, he came out swinging.
He went on the offensive. He explicitly blamed Chinese traders for the crash. He called the situation out of control. His exact diagnosis was a classic speculative meltdown driven by runaway fluctuations originating in China.
Okay, so let's parse that. Speculative meltdown. To me, that sounds like a bubble popping. But what does that actually look like in the gold market? Because I don't usually think of gold as a bubble asset.
It usually isn't. But in this case, we saw what's called a parabolic move. If you looked at the chart leading up to the crash, the price line wasn't going up gradually. It was going almost straight up, vertical.
Which is the classic sign of FOMO, fear of missing out.
Exactly. In a healthy market, price is determined by fundamentals. Miners digging it up, jewelry makers buying it. But in a speculative mania, people buy simply because the price is going up. They think, I'll buy it at $5,000 because I can sell it to someone else for $6,000 tomorrow.
The greater fool theory.
That's the one. And according to Bessent, the fools in this scenario, or at least the people driving the frenzy, were in China.
And the data supports that.
It does. We saw just a tidal wave of capital coming out of China. And it wasn't just big banks. It was everyone. Large capital funds, sure, but also a massive surge of individual retail investors, just regular people trying to ride the wave.
So they flooded the market.
They did. They drove the price to these dizzying heights and completely detached it from reality.
But bubbles burst all the time. Usually, gravity just takes over. What makes this crash different is that it feels like it didn't just pop on its own. It feels like someone deliberately stuck a pin in it.
That's a very, very accurate way to put it. This wasn't a natural correction. It was a forced liquidation.
Yeah.
The exchanges, the people who run the market, they stepped in and changed the rules of the game to stop the madness.
Which brings us to margin requirements.
Exactly.
Okay, let's pause here and really break this down. Because I feel like margin is one of those financial terms people hear and they just sort of nod along to, but maybe don't fully grasp the mechanics of. How does a margin hike actually crash a market?
Okay, so think of it this way. Imagine you want to buy a house that costs $1 million. You don't have $1 million in cash. You have maybe 100,000.
Correct.
So you put that down as a down payment, 10%, and the bank lends you the rest.
Right. Standard mortgage stuff. I'm with you.
In futures trading, that down payment is your margin. You put down a small amount of cash to control a massive amount of gold. This is called leverage. If you put down 10% and gold goes up 10%, you've actually doubled your money.
Which is why everyone loves leverage on the way up. It's like a magic money multiplier.
Precisely. But here is the trap. The exchange, which acts like the bank in this analogy, they monitor the risk. If the price starts getting too volatile, or if they think the bubble is getting dangerous, they can raise the margin requirement.
So they can just change the terms.
Instantly. They can say, hey, that 10% down payment, it's not enough anymore. We need 20%. And we need the cash in your account by the end of the day.
And if I'm a trader who just got all my cash buying the gold in the first place?
Then you're in trouble. You get a margin call. And if you can't wire the extra cash immediately, the exchange automatically sells your gold to cover the debt. They liquidate you.
And if they do that to thousands of people all at once?
Then you get a massive wave of forced selling. That selling drives the price down. And when the price drops, more people fall below their margin requirements, triggering more automatic selling. It becomes a doom loop.
And that is what happened this week.
That is exactly what happened. The CME group here in the U.S., the main exchange for these things, they hiked margins on gold futures 3 separate times in 1 week. They raised it from 6% to 9%.
See, 6 to 9% doesn't sound like a big number to the average person. It sounds like a rounding error.
But do the math on your capital. That is a 50% increase in the cash you need to have just to keep your position open. If you were leveraged to the max, a 50% hike is a death sentence.
And they hit silver even harder.
Yay here, much harder. Silver margins went from 11% to 18%. That's nearly double.
Wow.
That explains why silver crashed 26% in a day. The traders were being forced to sell at any price just to survive.
But it wasn't just the U.S. pulling these levers. This is where the China part of the story gets really concrete.
Right. It was a coordinated squeeze. While the U.S. was hiking margins, the Shanghai Gold Exchange, the SGE, and the Shanghai Futures Exchange did the exact same thing. SGE hiked deferred gold contracts from 17 to 18% and silver from 23 to 24.
That's rare, isn't it? To see the U.S. and Chinese exchanges moving in lockstep like that.
It implies a shared panic. I mean, both sides looked at this price bubble and said, we need to kill this before it blows up the whole financial system.
And since the money was mostly Chinese?
As Bessent said, yes. So when Shanghai tightened the screws, those investors were the first to run for the exits.
Do we have proofs that it was actually Chinese selling that drove the drop? Or is Bessent just looking for a convenient scapegoat?
It's a fair skepticism, but the data seems to back him up on this. We have reports from the Shanghai Gold Exchange showing a massive drop in net long positions.
So the number of people betting the price will go up.
Exactly. That number dropped off a cliff. And that drop happened over a 4-day period that perfectly matches the price collapse.
So the balloon was full of Chinese hot money, and the regulators in both countries worked together to pop it.
They forced the unwind, drained the liquidity pool.
Okay. Now, if the story ended there, it would be a fascinating lesson in market plumbing. You know, don't use too much leverage, kids. But there is a second layer to this story that I find way more interesting.
It moves from finance into spy novel territory.
It really does.
Yeah.
You're talking about the digital asset theory?
Yep.
This came up during Secretary Bessent's testimony to the Senate Banking Committee. He was responding to Senator Cynthia Lummis. And they weren't just talking about the crash. They were talking about what China might be planning long term.
This is the geopolitical what if that has everyone nervous. There have been reports, and Bessent stressed they are unconfirmed, but he clearly takes them seriously.
You wouldn't have mentioned it otherwise.
Right, that China is using Hong Kong as a testing ground for a gold-backed digital asset.
Okay, let's unpack that. We have Bitcoin. We have stable coins like Tether that are pegged to the U.S. dollar. But a digital currency backed by physical gold bars. Why would China want that? What's the strategic advantage?
It's all about the U.S. dollar. Right now, the dollar is the global reserve currency. It's the weapon the U.S. uses. If we don't like what a country is doing, we sanction them, and they can't use dollars.
They get cut off from the global trade system.
So if you're China or Russia or Iran, that's a huge vulnerability.
A huge one.
Exactly. But if you have a digital currency that can move instantly across borders, settled on a blockchain, and it's backed by gold, a universally recognized store of value that the U.S. doesn't control, you suddenly have a shield. You have a way to trade that is immune to U.S. monetary policy, immune to U.S. sanctions.
It's the holy grail of de-dollarization.
And Bessent told the Senate he wouldn't be surprised if that's exactly what Beijing is attempting.
So let's put on our detective hats. How does this connect back to the crash we just saw?
Well, it's the theory everyone is whispering about. If China is preparing to launch a gold-backed currency, they need gold, a lot of it. They need to accumulate massive reserves to back the digital tokens.
So the frenzied buying Bessent described, maybe that wasn't just retail guys getting greedy. Maybe some of that was state-sponsored accumulation disguised as speculation.
It's possible. Or maybe it was a stress test. Maybe they were testing the liquidity of the market, trying to see how much gold they could soak up before the price broke.
And maybe they broke it.
Well, if that's the case, it was a failed launch. If you try to corner the market to back your new currency and you accidentally trigger a global margin call that wipes out your own investors, that's a bad day at the office.
It does explain why the Treasury Secretary is paying so much attention to it. Linking Chinese speculation and gold-backed digital assets in the same week suggests the U.S. government sees this as more than just a market glitch.
Oh, they see it as a potential skirmish in a currency war. If China succeeds in creating a viable gold-backed digital currency, it challenges the supremacy of the dollar. The volatility we saw this week might just be the messy birth pangs of that new system.
Which is a terrifying thought for stability. But speaking of stability, or maybe the illusion of it, we have to look at the other side of the screen. Because while the gold bugs were having a heart attack, the U.S. stock market was having a party.
It is the ultimate paradox, isn't it? Usually when gold crashes, it means there is panic. Liquidity is drying up. You'd expect stocks to take a hit. But look at the Dow Jones.
It didn't just hold steady, it made history.
February 6th, 2026. The Dow Jones Industrial Average crossed 50,000 points for the first time ever.
50,000. I remember when 20,000 felt like a huge deal.
Yeah.
It feels like we're in a different reality.
It's a massive psychological milestone, and Secretary Bessent is using it very effectively to counter the narrative of chaos.
This is where the politics come in. We can't ignore the calendar, can we?
No, absolutely not. We are staring down the barrel of the 2026 midterm elections in November. The administration needs a win. They need to project strength.
So Bessent goes on TV. On one hand, he's putting out the fire in the gold market by blaming Chinese speculators, basically saying that's their problem, their mess. And on the other hand, he's pointing at the Dow saying, look at this. The U.S. economy is undeniable.
Precisely. He called it an upward cycle that will benefit ordinary Americans. It's a very deliberate framing. He is trying to decouple the U.S. stock market from the global chaos in metals. He wants voters to look at their 401k balance, not the price of gold coins.
But does that decoupling hold up? I mean, can you really have a record-breaking stock market while the traditional safe haven asset is imploding?
Short term, yes, clearly. But long term, it's risky. Markets are interconnected. The liquidity that evaporated from gold, those billions of dollars lost, that has to come from somewhere. The margin calls that wiped out traders in Shanghai or New York, that pain travels.
It feels fragile to me. Like, sure, the Dow's at 50,000, but the fact that regulators had to intervene so aggressively in gold, it suggests they were afraid of contagion.
They were terrified of it. Think about it. If that gold crash had kept going, it could have blown up hedge funds that hold both gold and stocks. If a fund loses $1 billion in gold, they might have to sell their Apple or Microsoft stock just to pay the bill.
So they sell the winners to pay for the losers.
Exactly. And that's how a gold crash becomes a stock market crash. The regulators hiked those margins to stop the bleeding before it reached the Dow. They managed to keep the walls up this time.
This time.
But the underlying tension, the tug of war between the U.S. dollar and these potential new gold-backed competitors, that isn't going away just because the Dow hit a new high.
So let's bring this all together for you. We've covered a lot of ground. We've got a historic 26% crash in silver, a 50,000-point Dow, and a shadow game involving digital currency in Hong Kong. What's the one thing you should take away from this deep dive?
I think the key takeaway is that volatility is shifting. We are used to crypto being the crazy volatile asset. We are used to tech stocks jumping around. We aren't used to gold behaving like a meme coin.
And we aren't used to safe havens being the source of the risk.
That's the critical shift. The very definition of money and value is being fought over right now. The gold crash wasn't just a bad week for traders. It was a visible clash between traditional market mechanics and this new wave of global, potentially state-sponsored capital flows.
So for the regular person, the listener, who just wants to be smart about this, What should they be watching?
Don't take stability for granted. The margin hikes prove that the rules can change overnight. Even if you aren't trading futures, you need to understand that global liquidity can dry up in a heartbeat if the regulators decide to pull the plug. And keep an eye on Hong Kong. If that digital gold project is real, this crash was just the prequel.
That is a sobering thought. I want to leave you with one final question to chew on. We tend to look at financial news as just numbers on a screen. But if Secretary Bessent is right, and China's building a digital currency to challenge the dollar, was this crash a failure on their part? Or was it a stress test that gave them exactly the data they needed for the next attempt?
A failed experiment or the first battle of a new world order? That is the question.
Something to think about while you watch those tickers. Thanks for diving deep with us today.
See you next time.